Greetings, Prof. Jais, and my fellow friends. Today, my group members, Clarissa Ramli, Norizatu, Crispina Ayang, Ani Hafifi, and I will be presenting Chapter 2 entitled Written Concepts. There are 6 subtopics under Written Concepts. To begin the presentation, I will start off with holding period return. Holding period return is the return earned from investing in an asset over a specified time period, where such returns can be separated into investment income and price appreciation components. The formula to calculate holding period return is as shown, where if the asset is a share purchased now at t equals 0, with t denoting time, and sold at t equals h, the holding period is t equals 0 to t equals h. The equation shows that the holding period return is the sum of two components, which are dividend yield and price appreciation return, or in other words, capital gain yields. Next is realized and expected holding period return. Realized holding period return is the selling price and dividend are known for a holding period in the past, unlike expected holding period return where it is unknown. As selling price and dividend are known, we can calculate the realized holding period return as shown in the example. It is calculated as dividend divided by beginning price plus the difference between selling price and beginning price, which is then divided by the beginning price. That is how you will get your realized return. Expected holding period return is just an expectation regarding the dividend and selling price for the stock that consists of the expected dividend yield and the expected price appreciation return. As for required return, it is the minimum level of expected return required to invest in the asset over a specified time period given the asset's riskiness. Basically, required return represents a threshold value for being fairly compensated for the risk of the asset. If the investor's expected return exceeds the required return, the asset will appear to be undervalued because it is expected to return more than fair compensation for the asset's risk. And in contrast, if the expected return on the asset falls short of the required rate of return, the asset will appear to be overvalued. To calculate assets' expected alpha, we just have to find the difference between expected return and required return. When an asset is efficiently priced, its price equals its intrinsic value, expected return should equal required return, and the expected alpha is 0. Meanwhile, to calculate the asset's realized alpha, we minus contemporaneous required return from actual holding period return. The asset's realized alpha is used by analysts to evaluate the actual results of an investment discipline. That is all from me. Now, I will pass to Clarissa to present the next subtopic.
Guys, my name is Clarissa and I will be presenting expected return estimate from intrinsic value estimate. When an asset is mispriced, one of several outcomes is possible. Take the case of an asset that an investor believes is 25% undervalued in the marketplace. Over the investment time horizon, the mispricing may increase, the asset may become more undervalued, stay the same, the asset may be remain 25 undervalued, be partially corrected, the asset may become undervalued by 15%, be corrected, price changes to exactly reflect value, reverse, or be overcorrected, the asset may become overvalued. Next, this is the formula of expected return. VO is intrinsic value, PO market price, T is time, IT is required return on a periodic basis. VO minus PO divide PO and estimate of the return from converges over the period of the length. IT expected holding period return on the same basis. Although only an approximation, the expression does illustrate that an expected return can be viewed as the sum of two returns, the required return and a return from convergence of market to intrinsic value. Next, 2.5, discount rate. General term of any rate used in finding the present value of a future cash flow. It reflects the compensation required by investors for delaying consumption. Discount rate also used to determine intrinsic value depends on the characteristic of the investment rather than the characteristic of the purchaser. A distinct discount rate could be applicable to each distinct expected future cash flow. A single required return is generally used to discount all expected future cash flow. Next, 2.6, internal rate of return. It is the discount rate that equates the present value of asset expected future cash flows to the asset price. In other words, the amount of money needed today to purchase a right to those cash flows. An IRR computed under the assumption of market efficiency has been used to estimate the required return on equity. So this is the formula of intrinsic value. Intrinsic value equal year-ahead dividend divide required return minus expected dividend growth. If the asset is correctly valued now, which is market price equal intrinsic value, given census estimates of the year-ahead dividend and future dividend growth rate, which are estimate of the dividend expectation built into the price. We can solve a required return and IRR implied by the market price, which is required return estimate equal year-ahead dividend divide market price plus expected dividend growth rate. The use of such an IRR as a required return estimate assumes not only market efficiency but also the correctness of the present value model and the estimate input to the selected model. That's all from me. So next I'll pass to Nurizatul.
Hi, I'm Nurizatul and I'll be presenting about the equity risk premium and historical estimates. 3.0, the equity risk premium. It is the incremental return premium that investors require for holding equities rather than a risk-free asset. Depends strictly on expectations for the future because the investor's returns depend only on the investment's future cash flows. Commonly used to refer to the realized excess return of stocks over a risk-free asset over a given past time period. The realized excess return could be very different from the premium that was contemporaneously being expected by investors. Using the equity risk premium, the required return on the broad equity market or an average systematic risk equity security, required return on equity equals to current expected risk-free return plus equity risk premium. Where for consistency, the definition of risk-free assets such as government bills or government bonds used in estimating the equity risk premium should correspond to the one used in specifying the current expected risk-free return. The importance of the equity risk premium evaluation is that in perhaps most cases in practice, analysts estimate the required return on a common equity issue as either required return on share I equals to current expected risk-free return plus beta, equity risk premium. This equation adjusts the equity risk premium for the share's particular level of systematic risk as measured by beta. An average systematic risk security has a beta of 1, whereas beta values above and below 1 indicate greater than average and smaller than average systematic risk. Required return on share I equals to current expected risk-free return plus equity risk premium plus minus other risk premium or discounts appropriate for I. This equation does not make a beta adjustment to the equity risk premium but adds premium or discounts required to develop an overall equity risk adjustment. 3.1 Historical estimates. A historical equity risk premium estimate is usually calculated as the mean value of the differences between broad-based equity market index returns and government debt returns over some selected sample period. When reliable long-term records of equity returns are available, historical estimates have been a familiar and popular choice of estimation. If investors do not make systematic errors in forming expectations, then over the long term, average returns should be an unbiased estimate of what investors expected. The fact that historical estimates are based on data also gives them an objective quality. These are the factors of analysts' major decisions in developing a historical equity risk premium estimate. First, equity index to represent equity market returns. Second, time period for computing the estimate. Third, type of mean calculated. Fourth, proxy for the risk-free return. Computing the mean. The mean return of a historical set of annual return differences between equities and government debt securities can be calculated using a geometric mean equity risk premium estimate equal to the compound annual excess return of equities over the risk-free return, and arithmetic mean equity risk premium estimate equal to the sum of the annual return differences divided by the number of observations in the sample. Proxy for the risk-free return. The risk-free rate can also be represented in two ways: as a long-term government bond return, as a short-term government debt instrument return. That's all from me. Next, I pass to Crispina.
Hi, my name is Crispina Yanajima with metric number 65732, and I'm going to present on the next points. 3.1.1 Arithmetic mean or geometric mean. Arithmetic mean return as the average one-period return best represents the mean return in a single period. With serially uncorrelated returns and a non-underlying arithmetic mean, the unbiased estimate of the expected terminal value of an investment is found by compounding forward at the arithmetic mean. Geometric mean is smaller by an amount equal to about one-half the variance of returns, so it is always smaller than the arithmetic mean given any variability in returns. The geometric mean is equal to the arithmetic mean when the returns for all periods are equal. Geometric mean return of a sample represents the compound rate of growth that equates the beginning value to the ending value of 1 unit of money initially invested in an asset. Geometric mean is a compound growth rate. It appears to be a logical choice for estimating a required return in a multi-period context, even when using a single period required return model. Equity risk premium estimates based on the geometric mean have tended to be closer to supply-side and demand-side estimates from economic theory than arithmetic mean estimates. 3.1.2 Long-term government bonds or short-term government bills. Long-term government bonds. Government bonds are preferred to even the highest rated corporate bonds as they typically have less or near zero default and equity market risk. Normal upward. Sloping yield curve tends to offset the effect of the risk-free rate choice on a required return estimate because the current expected risk-free rate based on a bond will be larger than the expectation based on a bill. Industry practice has tended to favor use of a long-term government bond rate in premium estimates despite the fact that such estimates are often used in one-period models such as the CAPM. A premium relative to bonds should produce a more plausible required return or discount rate in a multi-period context of valuation. Next will be short-term government bills. With an inverted yield curve, the short-term yields exceed long-term yields, and the required return estimate based on using a risk-free rate based on a bill can be much higher. A risk premium based on a bill rate may produce a better estimate of the required rate of return for discounting a 1 year ahead cash flow. 3.1.3 Adjusted historical estimates. A historical risk premium estimate may be adjusted in two ways to neutralize the effect of biases that may be present in the underlying equity market return series. One type of an adjustment made to offset the effect of biases in the data series being used to estimate the equity risk premium. Second type of an adjustment made to take account of an independent estimate of the equity risk premium. In both cases, the adjustment could be upward or downward. One issue is survivorship bias. This bias arises when poorly performing or defunct companies are removed from membership in an index, so that only relative winners remain. A conceptually related issue with historical estimates can arise when a market has experienced a string of unexpectedly positive or negative events, and the surprises do not balance out over the period of sample data. In such cases, a forward-looking model estimate may suggest a much lower value of the equity risk premium. So to mitigate that concern, the analyst may adjust the historical estimate downward based on an independent forward-looking estimate, or upward in the case of a string of negative surprises. For example, a string of positive inflation and productivity surprises may result in a series of high returns that increases the historical mean estimate of the equity risk premium. That's all from my parts. Now I'm going to pass to Fifi for the next presentation.
Hi guys, my name is Fifi. So today I'm going to present about forward-looking estimates. As equity risk premium is based only on expectations for economics and financial variables from the present going forward, it is logical to estimate the premium directly based on current information and expectation concerning such variables. Such estimates are often called forward-looking. Forward-looking estimates are likely to be less subject to an issue such as non-stationary or data bias than are historical estimates. So, under forward-looking estimates, there will be three models, which is the first, Gordon growth model estimates. The most frequently encountered forward-looking estimate for the equity risk premium is based on a very simple form of a present value model called the constant growth dividend discount model, or Gordon growth model. Expected dividend growth rate may be inferred based on published analysis or economic expectations such as consensus analyst expectation of the earnings growth for an equity. Below are the equity risk premium estimates. The equation is based on assumption of earning growth at a stable rate. An assumption of multiple earnings growth stage is more appropriate for every rapidly growing economies. Next model is macroeconomic model estimates. Using relationships between macroeconomics variables and the financial variables that figure in equity valuation models, analysts can develop equity risk premium estimates. Such models may be more reliable when public equities represent a relatively large share of the economy, as in many developed markets. To illustrate a supply analysis, the total return to equity can be analyzed into four components shown below. The last model is survey estimates. One way to gauge expectation is to ask people what they expect. Survey estimates of the equity risk premium involve asking a sample of people, frequently experts, about their expectations for it, or for capital market expectations from which the premium can be inferred. So guys, that's all for the topic today. Thank you. That's all from us. Bye.